Hello, managers. How are you? This is a video of the free session that we had on the 24th July, 7 p.m. for FMA500. And my name is Mr. Ladova, and I'm the one who's going to be assisting you throughout the semester with the module. So, the topic that we're going to be covering tonight, or the chapter, it is the portfolio management and the capital asset pricing model. Now, there's more to this chapter than what we are going to be covering in this video, but some of the things which are important that you need to understand is that you should be able to understand the background to portfolio theory. Major focus will be on portfolio theory, so that means you're going to be calculating or looking at two assets or two shares, so it's more than one. You have to also know how to explain the investor's attitude to risk. You have to illustrate graphically the combination of two or more portfolios. So you might have to draw some graphs at some point, just one or two graphs under this chapter. You also have to know CAPM, which is the capital asset pricing model, explain the derivation of the capital asset pricing model. But in this video, we're just going to be covering what is usually there in your assignment or in your exam. So I've shared this document with students. If you want to join the FMA group, FMA500 group, you can just click on the link that you see over there. And then if you need more information, you can just contact the numbers 079-031-2715. Okay, now I have compiled some key concepts, keywords that you need to understand over here. I won't be reading them. I think you can read them on your own. So we'll just go straight into the calculations. Okay, so the question that we have here says Mr. Ledova's Africa Academics wishes to buy 100% of Stadio. Okay, so the keyword is wishes, so it's a wish. Now we have a table which gives us information about these two companies and the market. Now this information is in terms of the expected return, standard deviation, which is a risk. If you have read the information I've provided below, above, then you would know that. And then you also have correlation coefficient. Just to go back a moment so that we can focus on those two things. Standard deviation is the chances of losing your investment, which is a risk. And then correlation coefficient there indicates strength and direction of a linear relationship between two assets or shares. Okay, so we have those three things in terms of Africa Academics, Stadio, and the market. And then the additional information which is provided to us over there is that government bonds, which are risk-free rate securities, are 7%. Okay, so this means the risk-free rate is 7%. Then we are told that the covariances of Africa Academics and Stadio is positive 0.2. Then the last point says, should Mr. Ledova's company successfully take over 100% of Stadio, the structure of the new company will be 80% of Africa Academics and 20% of Stadio. So just to explain more on this last point, remember the first thing that we learned is that Africa Academics wishes to buy 100% of Stadio. So if they do, then what this means is that the new company that is formed, because it will be a combination of Stadio and Africa Academics, 80% of it will be Africa Academics, and then 20% of it will be Stadio. So together they will make a new company, which is 100% of the new company. Okay, so these are the weights of these two companies within the new company. Now we have here what says answer the following questions. So we have to calculate the beta coefficient of Africa Academics and Stadio, and then the second one we have to calculate the cost of equity of Africa Academics. The third one we have to calculate the expected return of the new company, which means both the Stadio and Africa Academics combined, not individually. And then also the standard deviation, which is the risk of the new company, which is Africa Academics and Stadio combined. Then the last one, we have to calculate Stadio's required return based on capital asset pricing model, which is also sometimes called CAPM. Okay, now let's start with beta coefficient. Now, because this is an introduction to this chapter, what I will do when I write the formulas, I will write them in full so that you are able to keep up. However, when you write a formula during the exam or the assignment, you will use symbols. As always, when you write a formula, you use symbols because the purpose of a formula is to simplify the message that we are trying to relay. Okay, so for us to calculate the beta coefficient, this is equals to standard deviation of a company. So this will be the company that you're calculating the standard deviation, I mean to say the beta coefficient for, times correlation. Okay, all of this over standard deviation of the market. Okay, now we have to collect this information from above because it is already provided to us. So we need the standard deviation of Africa Academics, we also need correlation, and then we also need standard deviation of the market. Sometimes standard deviation is referred to as risk. So the standard deviation of Africa Academics is 6%. Okay, it's given over here. And then the standard deviation of the market is 5%. Now the correlation coefficient of Africa Academics is positive 0.4. So this is the information that you're going to be using to calculate your beta coefficient. So you'll have over here 6% times positive 0.4 divided by 5%, which is the standard deviation of the market. Now, if you're using a casual calculator, then this should be straightforward for you when you do the calculation. And then the answer that you will get is positive 0.48. This is for Africa Academics. And then you also have to calculate for Stadio. So the standard deviation for Stadio is 8%. And then the correlation is 0.7, positive 0.7. Then the standard deviation of the market remains 5%. So the standard deviation for all of them will be 5%. I will use the same formula, obviously. So I'll just say equals to 8% times 0.7 divided by 5. And then that should give us a positive 1.12. So this is beta coefficient of Stadio. Okay, so we are done calculating the beta coefficient. I think that was straightforward and simple. The next thing we have to calculate is the cost of equity of Africa Academics. So as always, the first thing that you must note, it is the formula. So remember, you do get marks for writing a formula because it shows understanding. So the cost of equity, the formula says, so I'll write it in full, but they are symbols of this. Okay, so you have over here the risk-free rate plus the beta coefficient, which we've just calculated, times the return of the market minus the risk-free rate. Okay, so the risk-free rate was given to us the beta coefficient, either it is given or you have calculated, and then the return of the market was given to us as well as the risk-free rate. So let's go and check what is our risk-free rate, our return of the market, and our beta coefficient. Okay, so we can see here that the return of the market is 16%. Okay. And then the risk-free rate is the first point of the additional information, which says government bonds in brackets, risk-free rate securities are 7%. So the risk-free rate is 7%. Okay, so the beta coefficient is not the correlation coefficient. Do not confuse the two. The beta coefficient of Africa Academics we have calculated here. It is 0.48. Okay, positive 0.48. So remember, we're calculating cost of equity for Africa Academics. That's why we use the beta coefficient of Africa Academics. So we then come back to substitute and say 7% plus 0.48 times the return of the market, which is 16%, minus the risk-free rate remains the same, 7%. So right away on your calculator, you can insert the whole thing, and then you should get 0.1132. Now, the cost of equity should be expressed in percentages, so you will multiply your answer by 100 to convert into a percentage, so that will be 11.32%. Now, always keep in mind that during your assignment or your exam, they will stipulate to how many decimals you should round off. So always take note of that and then use that. So this is the cost of equity for Africa Academics, and then we are done. So far we have done cost of equity and beta coefficient. We now move to the expected return of the new company. So it is key, new company. Okay. So once again, we will write down the formula for the expected return of a portfolio or two shares or two assets. So we have expected return over here is equals to, so you'll have the weight, okay, of Africa Academics. I'll just write AA there, an abbreviation for Africa Academics, times the return or the expected return. I'll write AA there to show Africa Academics, plus the weight of ST, it is Stadio, times the return of ST, which is Stadio. So what is the weight? If you still remember at the beginning, we did mention that after the two companies form a new company, Africa Academics will be, so I'll just write AA, it will be 80%, and then Stadio, we did say it will be 20%. So this is the weight of the companies. As for the return or the expected return, it is provided to us in the table, so we can just go and then look to see what it is. So the expected return for Africa Academics is 12%, and then the the expected return of Stadio is 18%. So you will just take those and then you start substituting. So remember, the weight of Africa Academics is 80%. So we'll multiply with the return of Africa Academics, which is 12%. Then you will add that, and then you'll say plus 20%, which is the weight of Stadio, times the return of Stadio, which is 18%. So you will then calculate that as it is on your calculator. So that will give you 0.132. So if you convert that into a percentage, it should give you 13.2%. That is the expected return of a new company. Okay, so we have calculated the expected return. We now calculate the standard deviation of the new company. So this is the risk of the new company. So this calculation usually is the one which gives people a challenge. So we calculate the standard deviation. I will write SD because the formula is quite long. Okay. So the formula says square root of weight of Africa Academics to the power 2. So I'll just write W there, times SD, which is the standard deviation, to the power 2 of Africa Academics. And then it continues to say plus the weight to the power 2. This weight is for Stadio, times standard deviation to the power 2. This is the standard deviation of Stadio. And then says plus 2 times the weight of Africa Academics times the weight of Stadio times the covariances of Africa Academics and Stadio. The only information that we know so far, it is the weights of Africa Academics and Stadio. We do not know the standard deviation of Africa Academics, standard deviation of Stadio, and the covariances of Africa Academics and Stadio. So we must go back to our information to learn what are those. So the standard deviation of Africa Academics is 6%. It's over here. It's given on the table just on this row. Then we have 8%, which is for Stadio. 6% is for Africa Academics. 8% is for Stadio. And then the covariances of Africa Academics and Stadio is positive 0.2. So now that we have the information, we can start the substitution. Okay, so we will start off with 80% to the power 2 times the standard deviation, which is 6% to the power 2 plus the weight of Stadio, which is 20% to the power 2 times the standard deviation of Stadio, which is 8% to the power 2 plus 2 times the weight of Africa Academics, which is 80%, times the weight of Stadio, which is 20%, times the covariances, which is positive 0.2. Now when you do this calculation, my advice is always do it twice, just to be sure, because we can make mistake on such a long calculation. Okay, so the answer that I'm getting over here is 0.2579922 So you'll just convert that into percentage. You should get 20 something percent. So you should get 25.799 and so on percent. Now, depending on the conditions of rounding off, this can be 26% if you round off to a whole number. So the standard deviation of the new company is going to be 26%. This is quite high. Okay, but over here we're just learning to calculate. That's why it's not that realistic. The last one that we have to do is the Stadio's required return based on capital asset pricing model. Now we have done this kind of calculation. However, we'll still do it again. So this is similar to cost of equity. But obviously when you write, you will say required return is equals to the risk-free rate. So I'll just write the symbols plus the beta coefficient. Okay, so times and then in brackets the return of the market minus the risk-free rate. So already we know that the risk-free rate is 7%. Then we also know that the return of the market is 16%. We just don't know the beta coefficient of Stadio, but we have calculated it, so we can just take it from our calculations. Okay, so here it is 1.2 12. That is the beta coefficient of Africa Academics. In case you're wondering where do I get those 16%, here are they, the 16% and the 7%. Okay, so now the only thing left for you to do is to substitute. So you'll have 7% plus 1,12 times 16% minus 7%. So you just do it as you see it on the screen. So you have 0,1708. Then if you convert that into a percentage, you should get 17.08%. Now this is the end of the lesson. Should you be interested in joining our preparations for the assignment and the exam, you can just contact the number that I provided above, which is 079-031-2715 on WhatsApp, or you can just call and then everything can be arranged for you. So you can call anytime and then you will be assisted. Thank you.